Welcome back. Absolutely flat for the frontline indices. The mid-caps doing well. Let's welcome the first corporate on our show. We have the management of Uniparts India, the engineering and system solutions company, plans to expand its customer base globally and focusing on diversifying into adjacent markets as well. Gurdeep Soni, who's the chairman and managing director, now joins us to discuss the business in detail. Thanks a lot, Mr. Soni, for joining in. I remember, post your IPO, the first numbers, you joined us and you said that 15 to 16% is the revenue growth that you're targeting for FY24, with margins between 21 to 22%. A lot may have changed since then with regards to the underlying. There has been a bit of a slowdown in Europe as well. A quarter of your business comes in from there. Would you hold on to that guidance or would you revise it lower?
Good morning and thank you for having me on the show. For the current financial year, because there is a softening in the small tractor business globally in USA and Europe, also the aftermarket business is showing softness primarily in the first Q1 and some in Q2. So we are forecasting a full year growth of a high single digit for the current year. But as soon as the inventory levels are corrected, we see moving to the 15 to 16% growth from next year onwards. We are, in fact, also delivered a fantastic results last year. And our EBITDA this year also is expected to be between 21 to 22%.
Okay, all right. Hi, Mr. Soni. Good morning. Thanks so much for joining in. So some bit of headwinds, it appears, for FY24, and that's why you're scaling back from mid-teens to high single digits. Got that. Give us a few more details. On your working capital days, it seems you've worked out there, because in the last year, it's come down by close to around 18 days to around 144 days. Do you expect this to improve even from year on? Give us what should be the targeted number out there. And also, if you could give us a quick idea about your dividend plans. Last year as well, you paid out hefty dividend, quite a large part of your EPS. Do you look at continuing the same?
So let me start with the dividend. We actually had a 25% dividend policy, but with the last dividend of 6 rupees, the second interim one, we have actually paid a total of 31%. We do see very high cash flows coming into the company. In fact, last year, the net cash flow was 252 crores, whereas the dividend has only absorbed 63 crores. We have, in fact, become cash positive. On 31st March, we were 46 crores cash positive, despite the dividend outflows. Coming back to the number of working days, yes, we dropped them, and that was primarily because of the improvement in the inventory. What was happening was that it was taking 90 to 95 days for inventory to reach USA and Europe. That has dropped from 55 to 60 days, and therefore the number of days of inventory that was held up on sea has dropped dramatically, and that has helped us to improve our number of working days down to 144. We are still looking at this number improving in about 138 to 140 days for the current financial.
And what about, I got the 130 to 140, but dividend payout, you'll continue to pay more than 25% of your EPS?
Definitely looks like that, because the cash approvals are really very strong.
Got it.
Right. And you obviously don't spend more than 3% of your revenues on CAPEX every year, any which way, as you've spoken of in the past as well. But let's talk about the adjacent products. I mean, you've developed a 3-point linkage system for UTV. I'm trying to understand the opportunity that comes in for you here, because the market opportunity, as pointed out by you, is close to 200 million USD. How much of that will be captured by you, and how much of that will be captured in the first year? How does that glide path look?
So you're correct. This is a market size of close to $200 million, which we expect in the next 3 to 4 years to be able to do about 200 crores of sales in this particular business, out of which we should capture about close to 20 crores in the current financial year, because the launch of this new 3PL system is being done sometime in November this year.
Mr. Soni, you're saying that your cash in your books is good. You're going to be generating good cash flows as well. So investors will be quite excited that, you could continue paying dividend. But given that you have good cash and you're going to be generating cash flows, there's some inorganic growth plans on your mind? If yes, could you tell us what could be the potential asset size? And will you announce something in this year itself?
So we are looking at 3 or 4 opportunities. It's too early for me to say which particular ones, but in the vicinity of 100 million to 150 million top line company, most likely in USA, but we are also looking in Europe. I cannot put a timeline to this because you know how these things are, but we are definitely looking at that. And you're right, with our very positive cash flows, we feel that most of that acquisition can be funded from in-house accruals.
What's the kind of acquisitions that you're looking? You gave us a rough size. Is it going to be in the sectors that you already operate in? Is it going to be adjacent sectors? Will they be profit accretive? I'm just trying to understand the spaces that you're looking at.
So we had said that while we are in the 3-point linkage, the 3PL and the construction machinery parts, PMP, but we are also looking at adjacent areas like power takeoff or PTO, construction and hydraulics. And the new acquisition that we are looking for is in the additional new businesses, which is of PTO and hydraulics.
All right. You know, Mr. Soni, you're saying that the acquisition target could have 150 million of revenues.
Correct.
What could that cost you approximately for your company? If I look at sales, since you've given the sales number, you're trading at close to around 2 times your past sales. So if the acquisition is for around 100 million odd, will the acquisition target be around 200 million?
Let me give you some more figures on that. So if it's 100 million top line, normally a US company is working at about 8 to 9% EBITDA level. So, and you normally can acquire a company for between 5 to 6 multiple, you know, so that arrives at, you know, a total cost of about 40 million. And if you could, you know, fund half cash and half debt, so you're looking at financing about 20 million from in-house.
So potential target will be a $40 million acquisition, right? The potential outflow, and then you'll have to see how to split it up. Correct. Yeah.
No, just reverse calculating math. He said that the companies that he acquires, 8 to 9% EBITDA margin would give it around $8 to $9 million in terms of EBITDA. Multiply that by 5 to 6 times, gives you a rough number of what we're looking at in terms of the size. But, you know, you yourself operate at 21 to 22% margins. Acquiring companies which does 8 to 10% margins would be margin dilutive for you, right?
Initially, it would be, but we target companies where we can bring in at least 35% of the business into India. We already have one company in the US, which when we acquired was at about 7 to 8% EBITDA. It has now moved down to about 11% now. But we moved about 40% of the business to India, and that added incremental of almost 30%. So, you know, initially, yes, it will be it will lower the EBITDA, but as we move forward, it will generate a lot more cash for the company.
And in the long term, India business will still be 13 to 17% as you would guide it for, right? Because if you're looking to bring these businesses into India, the contribution from India would increase as well.
Right. So what we sell in India is about 14% of our top line, you know, at this moment, and we'll stay in the 14-15% vicinity.
Yeah. Okay. All right, Mr. Soni, good chat with you. Thanks so much for stopping by and filling us in with some details. We're going to be looking forward to that inorganic growth, and we'll be happy to host you here on CNBC-TV18. For the time being, though, we'll slip into a short break. On the other side, we'll continue to focus on markets and stock-specific action.